All right, we're going to get started. Good afternoon, everyone. Thank you and welcome to the Cornerstone Wealth Financial and Market Update for first quarter 2022. I'm Jeff Carbone, Managing Partner at Cornerstone Wealth, and as always, joined by our Chief Investment Officer, Cliff Hodge. Good afternoon, Cliff.
Hey, Jeff. How are you, sir?
All is well. Well, just a reminder, we are recording the session, and we will post it to our website, YouTube channel, Facebook, LinkedIn, etc. And we'll have that out in the next day or so. But when you do see that, feel free to share the presentation with colleagues, family, friends, for them to learn more about the Cornerstone team. If there's any questions at the end of the presentation, we will answer any questions. So if you go to the Q&A box, enter that, and we'll try to get as many questions answered as we can. Well, as the year flies by, it's certainly been pretty eventful, from the invasion of Russia into Ukraine, the Fed Reserve starting the tightening cycle, seeing the highest inflation rates in over 40 years, and soon we'll see the midterm elections kicking in. The game has certainly changed in 2022, and we're after 3 straight years of strong returns in the equity markets. We're now seeing signs of a late cycle, or at least I would say late mid-cycle, maybe, economy with a slowing growth and in higher inflation pressure. This has led the markets to pull back here in the first quarter. We saw the S&P drop, not for the quarter, but at one point was down about 13% before recovering into the end of March, and the S&P finished down about 6%. At the same time, the bond market, which has had just as much volatility, or probably even more, finished down over almost 6% as well. By the end of April, we're now down, as of last night, not counting today. Today's a good recovery day, but the S&P was down nearly 12% and the bond market almost 9%. So definitely volatile on both sides of the fixed income as well as the equity markets. With that pressure from the Fed, again, we've seen those interest rate sensitivity. The Fed has now changed the pattern from where we were looking at maybe 4 interest rate hikes in 2022 to finishing the year about 2.5% on the Fed funds rate. So a big change has taken place. With all that has gone on in the financial markets, and really not a whole lot of financial updates to go. I want to spend most of the time today with Cliff sharing again where we were for the first quarter 2022, what we see here Q2, how we're looking at positioning and adjusting the portfolios to be in alignment, and we'll spend more time there. I do want to say we are keeping an eye, our eyes and ears open. A couple weeks back, we did hear the rumblings again of possible tax changes, so we'll see what President Biden may bring to the table, see if any steam gets picked up, any on potential tax law changes. If they do, we'll certainly spend some time going over and discussing that. So Cliff, again, the game has certainly changed. So why don't we jump in and let's start the presentation. Tell us what's going on in Q1.
Well, Jeff, eyes and ears on taxes, also eyes and ears on Amazon and Apple earnings this afternoon. I've had a couple of headlines flash across my screen. Looks like Amazon maybe not so great, but we'll see what happens. A lot of action in the markets today, and a lot of ground to cover. And so, as always, we'll kick us off by just a quick review of first quarter 2022. Hit on some of the high-level talking points that we mentioned to kick things off at the beginning of the year. Big takeaways there. Largely, it has played out as we expected. Maybe a little more negative on the returns than perhaps we thought. But I think for the rest of the year, as we'll discuss, the environment gets a little bit better for risk assets. Then we'll look at our 3 top notes for the call. As as you mentioned, the economy is in the process of transitioning from that mid to the later cycle stages, where both growth and ultimately what we think inflation is going to slow the second half of the year from pretty high levels. But the key takeaway, importantly, is that recession risk for us is not on the table as of right now for at least the next 12 months. There was a little bit of a jarring headline on GDP this morning. We can certainly talk about that during Q&A, but negative 1.4% growth rate in GDP. However, there was a lot of noise in that data with some anomalies from trade as it relates to COVID. So below the surface, more of a net neutral reading on GDP, but we can talk about that if we'd like. Point number two is inflation. That's front and center on everyone's minds. As you mentioned, the highest inflation rates in over 40 years, which, as you know, Jeff, is quite a long time. But in our estimation, the best cure for high prices is high prices. And there's a lot of data that we've seen that is going to show that inflation is likely to slow. And then ultimately what that is going to mean for bonds and for financial markets. And as you can see from the note there, ultimately we think it's going to be bullish for bonds. So the setup is getting more interesting. And then last but not least, the inflation and interest rates are really important because of the reaction function of the Fed. They've been very hawkish in what they have been saying in press conferences and in their official communications. We look at what's priced into the market today, and we think ultimately the bark is going to be worse than the bite. And again, another data point that has us leaning a little bit bullish. But perhaps not without some interim volatility as we head into the summer. So with that, Jeff, if there's not anything on your end, we'll get rolling here.
Let me unmute. Let's get started.
Okay. Yeah, great. So yeah, this is just the slide from the kickoff. What we said was that 2022 is really going to be the year where tailwinds become headwinds and to get ready for some volatility. Safe to say we've certainly seen that play out in the first quarter, as Jeff mentioned, and we'll look at some of the market returns here momentarily. Also, geopolitical headwinds. This was pre-Russia-Ukraine invasion. There was just some saber rattling going on at the time, some noise out of China as well with Taiwan and midterms were all things that were on the radar. All things that have added, continue to add to the uncertainty for financial markets. And then we said in times of uncertainty, we really want to seek certainty with our investment portfolios and really focus on purpose. And, one of the major pivots that we were recommending to clients at the beginning of the year, and frankly still are recommending, was the alternative portfolio and making sure that you had some additional diversification to your traditional asset classes. And we're certainly happy with the results of the alts portfolio so far. We said that was our highest conviction given the interest rate environment, and certainly happy to say that at least through close of business yesterday, our alternative portfolio is up over 3% year to date, whereas everything else is essentially down. So we'll take that and continue to reinforce the messaging with the benefits from alternatives. But on the equity side, we talked about having a combination of some cyclical exposures and some things that work well in a growth slowdown. So lower volatility, more defensive kind of positions, which have certainly held up a little bit better than the indexes. Same thing from a quality perspective. You want high quality companies with strong returns on capital, clean balance sheets, things like that. And again, those have continued to hold up. Still down, but a little bit better overall, alongside something like energy, which is really the only sector that's been positive year to date and continues to work. A lot of it driven by some Russia-Ukraine headlines. On the fixed income side, really the biggest relative positioning that we had on was that we were underweight duration or underweight interest rate sensitivity. As you all may remember, bonds and bond prices rather, and interest rates move in opposite directions. So as inflation pushes interest rates up, bond prices fall. And so that's why we've seen such volatility in the fixed income space. So we've had a short duration bet on and more conservative managers and aggressive asset classes. And so that combination has worked well for us for fixed income, still down, but by much less than the overall benchmarks, with a much better setup going into the second half of the year. So as we mentioned, for the first quarter, really nowhere to hide. Major equity indices were all down, roughly 5%. I think as of yesterday, as Jeff mentioned, the S&P's now down nearly 12. We got 2.5 today, but looks like Amazon and Apple may not save the day tomorrow. So we'll have to see how that goes on the equity side. But perhaps what's most surprising is that bonds continue to be negative. With the ag down 6 in the first quarter. Again, that's like the S&P 500 for the bond market. Investment grade corporate bonds down nearly 8. And unfortunately, through the month of April, as Jeff mentioned, the ag is now down roughly 9 year to date. So the bond picture has certainly been challenging. Whereas, again, on the alternative side, really a great place to be for our clients during the first quarter, and will continue to be a shock absorber, we think, as we move through the cycle. So that's the story for 2021. Really, it's largely played out as expected, and now we're going to get ready to look forward for the rest of 2022.
Well, Cliff, as you shared, again, the economy is beginning to slow. We saw the inflationary pressure that was starting. Well, it was not transitory as the Fed had originally thought. We've certainly seen that inflation in all the things we do. Again, great reasons why you did take more defense from both the fixed income side as well as the equity sides in the portfolio. Again, it was brilliant to take the duration risk down on the bonds, because as rates went up, saw bonds really get affected. And we'll certainly spend a little bit more time talking about that. How do we position going forward? So let's kind of, maybe flip now towards where we see things going into Q2. And let's talk about the data and what we're watching.
Yeah, absolutely. And before we get into the specifics, I'll do a quick plug on our process, because that's really, for us, where it all starts and where it all ends is our process, and making sure that we follow our data-driven process. It's repeatable and robust. It's not based on emotions or feelings or things of that nature, but really a data-driven process that we continue to improve and enhance. Whether it be from the macro side with the business cycle and the quads, which is how we measure the growth and inflation regimes. The fundamentals. We look at valuations, earnings, cash flow trajectories. But then how is the street positioned, right? Understanding where the key players are, where the risks are, so that when everyone is tilted to one side of the boat, perhaps we're looking to take the other side of that for the benefit of our portfolios and for our clients. And so with that, we'll first hit on that first major data point, in that, according to the data and everything that we're seeing, the economy is now peaking and transitioning toward later in the cycle, as we kind of have hit the inflection point and are going to come down the other side of that sine curve. We think that this means that growth is certainly already peaked out, and inflation is in the process of peaking out, which we're going to talk a little bit more about as we move forward. But key takeaway here is it's perhaps not a bad time, if you haven't done so already, to take some chips off the table for exposures that are very cyclically oriented, making sure that we continue that transition into high quality, into lower volatility. But importantly, quite a bit of runway here before we think we get into that contraction, recessionary phase that has now become a hot topic in the financial press and the financial media. We still think we've got at least a year, if not 18 months, or perhaps even 2 years before recession is a major concern for us. And we'll talk about why. From a quad perspective, and I like to draw the analogy of the business cycle as our roadmap, kind of giving us the long-term direction and path of where we want to end up, and the quads as the GPS, right, which help us navigate from that day to day. And what we're seeing from a quad perspective is we're coming out of a period in the first quarter of 2022, which we would forecast or we would categorize as quad 3, where growth has decelerated. We saw that with GDP. It was actually negative this morning. And inflation continues to accelerate. So that bit of that stagflationary environment for the first quarter will now transition into what we think is going to likely be the potential for 2 or 3 quad 4s in the second part of 2022, as growth decelerates from a high level, and then inflation decelerates as well, which we actually believe the March reading that was just reported earlier this month perhaps is the peak, and things will improve. I will call out this 3Q 2022 number is right here on the line. So there actually is, the models are telling us there's a chance that we actually may pick up a little bit of reacceleration coming out of the summertime, going into the midterms. So I want to flag that here. Obviously, this number is going to change as we move through the year. But there's a chance that, if we do get a little bit of reacceleration in economic growth, even if it's for a quarter, that'll help at the margins from a returns perspective. So that's something that we're watching closely. And I think it's always important to highlight with the quads that the quads are really just a framework and a starting point, right? So every cycle is different, and so it's really important to make sure that we have an understanding of the nuances of what's happening on the ground today in this particular cycle. And one of the things that is different this time, going back over the past 30 years, is just how great the consumer, how great a shape the balance sheet is for the U.S. consumer. Very strong financial position. If you look at net debt, right, which is total debt, and then you account for the cash that folks own, is actually negative for the first time in over 30 years. So the consumer is in a very strong financial position. Household net debt to GDP also is right at the zero bound. We haven't seen that since the early 90s. So this is a very important metric as we move through the late cycle into recession, because even if we do get a recession, in 18 months, 2 years, whatever it is, it's likely to be much less impactful from an economic standpoint, because we don't have the massive buildups of debt and leverage, right, like we did back in 08 or even in 2000 in .com. So more to come on that, but anecdotally, we see that consumers are cash rich. We've also had some really positive headlines from some earnings calls, places like Bank of America, Visa, and even MasterCard this morning, just highlighting how strong the consumer is from a spending perspective. And even in GDP, even though the number was down 1.4, the consumer spending portion of it, which accounts for roughly 70% of GDP, was actually up 3% year over year. And so, when you peel the layers of the onion back, we see that the economy and the consumer is actually in a pretty good spot, all things considered. Last but not least, I did want to hit on the yield curve. We've got some questions about this, and it's really hot topic on CNBC and in the financial press. But when the yield curve invert, this is important because the curve inverted briefly this month, which means that the interest rates on 10-year treasuries fell below those of 2-year treasuries. And that's highly abnormal and has actually preceded every recession, at least going back to this chart, but I believe even going back to World War II, the yield curve always inverts prior to recession. And so given the fact that we saw this, we saw the 10-2 curve invert back in April, it's really, causing a lot of financial pundits, things in the Wall Street Journal as well, to start the clock ticking on recession. But we really don't think that's the case. And it's important never to just anchor and focus on one data point. But as you can see, as we walk through these, the curve inverted. This is a zero line. So anything below this white line is inversion. these red bars are recession. And so you can see, every time from really going back to every recession, even in COVID, which is really interesting, the curve is always inverted. But when you look at other parts of the curve, this is the 2-year minus the Fed funds rate, which is the policy rate that the Federal Reserve sets. If you look today, same pattern here, reversion every time before recession. But what you'll notice is that the lead times are much lower, right? So these things give us a little bit of a cleaner view on really when you need to start that clock ticking. And on average, when this series inverts, it's about a year before recession. Very steep, the steepest levels we've seen since going back to the mid 90s. So the shorter lead time indicator really gives us confidence that alongside what we're seeing from a growth perspective, what we're seeing from a consumer perspective, that and earnings, right? Perhaps that we're going to be in pretty decent shape from an economics perspective moving forward. Peaking, slowing, but certainly not worried about recession at this point, Jeff. So that's the good news today. Perhaps more good news than bad at this point.
Well, thanks, Cliff. I mean, you thanks first for reviewing the investment process. Again, it's a good reminder that that's not, there is a process, there's a method to why there's changes made in one's portfolio, why based upon the data and the facts that are coming in. So again, thanks for just the review and the update on that. Also, again, as you mentioned, the R word has been out, the recession word. But again, recession, there's a lot of indicators, not just that 10, the 10-year and the 2-year, 10-year basis. So, and like you said, it's, there's still runway and we're continuing to watch, we're making adjustments. So again, just all good facts as you look back in Q2. So, or we look forward in Q2 as we started. We're not out of the woods, right? Maybe there's less bad news that we could be seeing. But again, we're not out of this totally, and hopefully there's more positive that continues to come in throughout at least the next quarter. Cliff, one of the really hot topics, and we've hit on it a little bit, has been the inflation. We haven't seen these inflationary numbers in more than 40 years. So I wanted you to take a little deeper dive today in talking about the inflation picture that we're seeing.
Yeah, Jeff, inflation is extremely important for the economy and for financial markets. And I think it's really going to be the major theme for the second half of the year and even going into 2023. And no secret, if you've been following us or listening to anything we've been putting out, we think that the bulk of the inflation move higher is behind us, and that likely we're going to be heading lower from here. And this, there are really a lot of knock-on effects, right? There's been a lot of comparisons to the 70s, almost hyperinflationary period where, we had mortgage rates in the 15, 20%, and we just don't see it. There are so many differences today that we think is not going to be an issue going into the second half of the year. So as always, what we do when faced with these economic paradigm shifts is we look back at history to see what we can glean and what we can understand and what may apply for us today. And so we looked at 6 inflationary shocks going back to World War II, right, going back to the 40s. And what we found is when we compare that to the period that we're in today, is that we're right at the average from a duration perspective. So on average, these inflation shocks lasted roughly 2 years before they rolled over. And we're at the average for the rate of change. So we've gone from 0.3 to 7.9, roughly 7.6% increase over those 2 that lasted just a couple of more months than where we are today. And so, the likelihood of that continuing to increase at an increasing rate, in our opinion, is extremely low. And so, we look at history, but then we also look at the current cycle. and trying to understand, again, what are some similarities, what are some differences. And what we're looking at here on the left is just the increases in CPI. It's just year over year CPI each month, going back a couple of years. And when you think about the calculation of inflation, how it works is comparing a basket of prices today to that same basket of prices at a previous point in history. And so year over year is what we care about. And as you'll see, when we look back to 2021, coming up against what are called base effects, so the comparison levels, there's these huge jumps in April, May, June that we're just now, this bar here is what we're going to be comping against in 2 weeks when they release the inflation number. So from a mathematical perspective, it's highly unlikely that these numbers are going to continue to keep moving higher and kind of extrapolate out linearly, more so that we're going to come down the sine curve, very similar to what we're already seeing in oil prices, for example. That's this graphic here. Oil prices have a good lead on CPI, typically by 2 or 3 months. We've seen oil prices peak in March and are starting to roll back over. Same deal with commodities in general, right? This is the CRB index, so it's more broad than just energy. It also includes food, metals, ag, so on and so forth. And from a rate of change perspective, again, year over year, this was in March. This was the peak, and now is rolling back over. Still positive, but moving lower. And so these things all have impacts to inflation and to that core CPI number on a bit of a lag. Another data point here that reinforces the same view, right? So we look at CPI. This is the core CPI in yellow, and then the surprises and momentum index in white. So again, that leading relationship both on the upside and on the downside. The surprises and the momentum led us higher and higher. We've peaked, we've rolled over. And so we think it's, again, we talk about a mosaic and trying to put different pieces together to come up with what's the highest probability path forward. And time again, as we keep stacking up these data points, we see the same figure. This is probably the most powerful relationship of all the ones that we track from an inflation perspective. What this is shipping, but really trucking. So we shift the data series 6 months forward because trucking gives us a great read, not only real time on the economy, but also real time on inflation. And again, we're right at the point 6 months forward where trucking and shipping have rolled over, and transportation is sort of slowed a bit. Which should again give us an update and another layer of confidence that our view that inflation is going to slow as we move forward. And so this is really important because inflation is probably the most significant driver of interest rates. And as we know, as we talked about, interest rates, bond prices move in opposite directions. So the thesis is, as inflation begins to slow, interest rates will begin to ease. The Fed will not have to be as aggressive as they've been talking, or potentially even as what the market is pricing in. And that really is the setup that is conducive to bonds, especially if growth continues to slow down, as we think is likely going into the latter part of the year. So you really get this almost double whammy effect with growth coming down, inflation coming down on interest rates, which then actually is a great environment for fixed income and for bonds. So one of our key takeaways for our clients and for those listening into the second half of the year is as you're meeting with your advisor and making changes to your allocations, don't abandon your bonds. They are very valuable to your portfolio. From a diversification standpoint, also at higher yields, the income component is a little better. So hang on to your bonds. We like the picture for them in the second half of the year.
All right, Cliff. Well, we talked about inflation, and you can't talk inflation without talking about the Fed right now. So the Fed initially And I'm thinking back to October, November of 2021, when the Fed minutes were coming out, we were looking at the data and we were looking at 4 potential rate hikes in 2022 and maybe 4 or 5. And we I remember talking with you and thought that was way too high. Fast forward to today, and you just told me, I think as we talked before the meeting, before the webinar here, Fed changed their policy to now we were going to see 8, possibly 9. And now you said, I think they even said now 10s in 2022.
10, Jeff, 10.
So, we were going from 1% Fed funds rate to 2.5. Now could be even higher towards 3. So let's talk about the Fed and their progression with interest rates.
Yeah, and the Fed is really kind of stuck between a rock and a hard place, right? They have a dual mandate, right, for stable inflation and low unemployment. And they've got the low unemployment, and we still have more jobs available that are open in the economy than we have people to fill them. And then we've got inflation at 40-year highs, and so really no surprise that they have been as aggressive in their rhetoric and in their forecast for what they're going to be doing from an interest rate perspective. But now we think that they're at the point where the market has kind of overshot the runway, so to say, on what the Fed is going to do. And so if we look at Fed funds, this is from yesterday, this actually ticked higher this morning. So now the market's pricing in 10, 25 basis point rate hikes by the end of the year, which would put Fed funds at roughly 2.5, 2.75. There's a little bit of room, wiggle room there, but if you look at this number here, so 50 basis point rate hike in May, I think we'll go through with that. Another 50 in June, another 50 in July, before 25 at the remaining 3 meetings on the year, and you never say never, Jeff, but I think the odds of being able to follow through on that are extremely low, because at the same time, what they're also doing is rolling off their balance sheet. Folks may have heard the term quantitative tightening or QT. So which is the undoing of QE, quantitative easing, which is where the Fed has been buying bonds, each month, Treasury mortgage bonds, really since COVID on overdrive, and so when you take that into account, there's a metric that we track that equates balance sheet shrinking or tightening to rate hikes. And so when you account for what's priced in the market, 9, now 10, plus all the balance sheet roll off, it's equivalent to nearly 20 rate hikes in 1 year. That is completely unprecedented by an order of 2. They've never been that aggressive in pulling anything off like that ever. And you never say never, but we're all about probabilities. And I don't know about you, Jeff, but betting on something that's never happened before is typically not a winning bet, and really not one that we're interested in making. And so this is going to have massive ramifications again if the thesis plays out and the Fed is actually able to pivot back a little bit more dovishly. That'll be great for bonds, it'll be great for stocks, and great for risk assets across the board. And we think that the potential for that setup looks really interesting going into the summer. And so again, as we do, we look back at market history and what happens during various tightening cycles. And so this orange line is what I want everyone to focus on today. This is considered fast cycles. So you hear a lot of comparisons today about 1994. That was considered a fast cycle. And what happens? We looked at during the S&P returns and then valuations, negative returns. So on the order of just eyeballing that here, we'll call it 15%, give or take. Same thing for valuation compressions, from north of 1 down to 82, so roughly 20% valuation compression during fast tightening cycles. Sounds kind of scary. Doesn't sound like you really want to own risk during that time period. You're telling me that the Fed's just starting this. Well, that may not make sense. But then you look at what we've already done from a PE and a valuation perspective. This is the PE ratio on the S&P 500 going back to 1989. So we were at 27 times earnings at the end of the year. We're now down to roughly 18. This is probably bumped up a little bit after today, so 18, 19. But the long run average is 17 and a half. And so just from here, from this peak, that's an 18% reduction in multiples. From the peak, it's over 30% reduction in multiples. So the market has already done quite a bit of heavy lifting from the valuation side. It's been painful and certainly unpleasant being down 12 on the S&P, but from a multiples perspective, it's double, almost triple, which is fantastic for going forward. So you look at valuations, but then you also want to look at earnings just to see what's going on that side, and earnings are holding up. This orange line is where we are, taking account actual earnings plus forecasts. Next year earnings estimates, again, they're positive but not egregious by any means. And so you think about the PE, it's the price and the earnings. Earnings are okay. Earnings are holding up. Mid-single digit growth year over year. Prices have come down. It's actually a pretty good setup for risk assets going into the latter part of the year. With the caveat, Jeff, as you mentioned, there's likely going to be some volatility over the summer as we get additional economic data points, and as we get big earnings from Apple and Amazon, and looks like Apple is up after hours, so that's good news. But just really going into the latter part of the year, we think that equity is likely going to work, fixed income is likely going to work, and that will end the year higher than where we are now. So from a portfolio perspective, just wanted to highlight some of the changes and things that we'll see. So we'll still continue to add and be adding to things that work well in a growth slowdown. We still want high quality, we still want lower volatility, but with where multiples are now, we're actually getting more and more interested in some growth stocks and some of these names, these high flyers that have been really beaten up. And perhaps another leg opening or another leg on the reopening trade. If you listen to earnings calls from Visa and MasterCard, travel and leisure spending has rebounded sharply and is now up above where we were in 2019. So we're likely seeing a shift from goods spending to services spending, which may benefit some of these reopening names. From an international markets perspective, we're still underweight international developed and EM, but they are starting to look more interesting, mainly because of what's been going on with the dollar. Clients may not know that the dollar, we are at 20-year highs relative to currencies, to other currencies on the dollar. And if, again, things play out as we predict, and the Fed is not able to follow through on being as aggressive, you'll start to see some easing in the dollar, which is going to benefit exporters and benefit international and emerging market opportunities. So we may be looking to add to those here over the coming weeks and months. From a fixed income side, the major change here is that we're going to begin, we already have at the margins, but begin to add duration or add that interest rate sensitivity back into the portfolio, especially in our flagship bond strategy. We've got a pretty good lead over the benchmark. We're down a little bit year to date, but yields are now higher, and we want some of that interest rate exposure because if rates fall, again, we want those bond prices to go back up. Meanwhile, making sure we continue to limit our equity correlation so that we've got good diversification benefit. And then last but not least, Jeff, alternatives. We're still big fans of alternatives. We've designed this portfolio to really be a full cycle shock absorber. And so, not too late to own alts. We think, pretty much almost every situation warrants at least some exposure to alternatives. So if you have not had those conversations yet with your advisors, do so, because really the power is the combination of the three, the equities, the fixed income, and the alts together can reduce your risk, increase your return expectations, and which from where I sit is ultimately what we're trying to do from an investment perspective. And so before we hand it off for Q&A, just want to hit on three takeaways for everyone to just kind of think about as they sign off on their computers and get ready for the summertime and Memorial Day and all that fun stuff that's going to be coming up. But likely going to still see some volatility here as we go into the summer. There's a lot of transition in the economy, a lot of uncertainty. We think the clouds are beginning to start to part, right? Hopefully, the supply chain issues continue to work themselves out. Russia, Ukraine, we're able to come to some sort of détente there where we can move forward. So we think ultimately that risk markets are gonna end the year higher, again, both from an equity and from a fixed income perspective. From the economy, from the macro lens, growth and inflation likely going to slow from high levels. Not worried about recession for the next year, probably not the next 18 months or even perhaps 2 years. That will change as the data comes in, but where we sit now, not worried about that. And then last but not least, your bonds. Don't abandon your bonds. They add diversification. They do add a bit of a shock absorber. And if things, again, play out the way that we think, bonds should work in the latter half of 2022. So with that, Jeff, I'll turn it back to you, and then we can open it up for any questions.
Thanks, Cliff. Yeah, we do have a question from Phil, and I think you may have answered some of this, Cliff, but maybe you can just do a recap. But do you feel the markets have built in slower growth to inflation, or is there still worsening, or is it likely worsening if inflation peaks, does not come down for some time?
Yeah, so I think what he's getting at is what's priced in from an inflation perspective and from a growth perspective, and it's tough to say exactly what numbers are priced in, but given that valuations have come in so much, I think a lot of the heavy lifting is done. Now, Amazon looks like it's going to be down 10% tomorrow. So could that drag the indexes lower in the short term? Absolutely. Could we get some one-off data point that causes people to rethink their thesis? Yes. But over time and as the data comes in, as we are able to establish the trend and new trends, I think that setup is going to be quite conducive to own risk. Now, if inflation doesn't come down for some time, I don't think that we're going to be back to 1.5–2% inflation anytime soon. Could we be, doing our year-end wrap-up call in December and inflation is at 4, 5 perhaps? Yeah, I think at that point, if we've got GDP, heading back toward trend at 2 to 3%, inflation's at 3 to 4 to 5. You still got pretty good nominal growth. You still have good earnings, and the Fed is maybe at I don't know 175, 2 on Fed funds, and the 10-year is lower than where we are today. So. That's actually kind of a Goldilocks scenario where, at least for now, I think that's our highest probability path. So hopefully that helps.
Well, thanks, Cliff. All right. Why don't, again, as you went over, we've got an economy that continues to show the signs of slowing, later stages. With that, volatility continues to pick up. Again, as I started, we had 3 years where we really saw very little volatility in the markets. Normal markets, in a year, we can see 10% pullbacks. We did not see any in 2021, and really didn't see it really going back to probably September, October of 2020. We have not seen big volatility movements, and we're seeing it here in the new year. Again, all reasons why, and again, from with you and the investment team, took the time to add more higher quality, add more defense, back up back to the duration down on our bond portfolios to kind of be ready for that slowing that we're going through right now. So, and again, it goes back to, this is about planning, which could be planning for one's financial future, planning for market condition, whatever it may be, having the patience, and then following certainly the process that you went over. So again, planning, process, and patience. Again, we continue to tell the story. When we again, we want to thank everybody for listening in. This will be posted again to the website, YouTube, and our Facebook and LinkedIn. So share this information with others. As you do, it's a good reminder of everything Cliff went over. It's about stress testing one's portfolio. And we do that internally for our clients, right? So stress testing against a higher dollar, stress testing against rising interest rates, higher inflation, whatever it may be. If your family, friends are not, it's a great time to make, hey, why don't you listen in to this presentation? So again, just another reason to spread the word and share again what the team at Cornerstone really does. Again, if we can answer any questions, if we haven't answered your questions today, certainly give us a call, reach out to your advisor, just give us a call in the office. We're always happy to help and spend some time going further into what we discussed today. Again, thank you for listening. Wish you all a happy spring, and we'll be seeing everybody real soon. Stay healthy and safe, everybody.